thank you for participating in that poll. That was interesting. Let's look at just this diagram gives a good indication of, oops, can't do that. This gives a good indication of the relationship between these four financial statements. So we begin with a beginning net worth or balance sheet. Net worth statement, interchangeable use for the word balance sheet, which lists the assets and the liability of the business. The ending statement, which lists the ending of the accounting year, the asset and liability situation. The statement of cash flows then explains all cash that goes in and out of the business throughout the year. It doesn't have much to do with profitability, but shows all the cash that flows in and out from all sources. The net income statement identifies the income and expenses related to the farm or ranch business and the net income derived from that business. And then the statement of owner equity identifies the change of equity that takes place between the beginning and the ending balance sheets. So the balance sheets are like a snapshot at the either end of the year, and the statements are like videos that explain what happened throughout the year. Okay, my advanced buttons disappeared. I'm really sorry to be inept at this, but they just disappeared. Oh, there they are. They just came back. Good. Okay, so it's as simple as similar to the way you balance your checkbook. You have a beginning cash balance. You have inflows and outflows that lead to an ending cash balance. You do this similar with using a complete set of financial statements. One thing we need to just mention before we get into this is the asset valuation problem. And this refers to how we value assets on a cost or market basis. Cost basis, which basic accounting says to use, is the actual purchase price of the asset minus any depreciation. In the case of land, since land isn't depreciated, it's the cost of the land that was original cost. Whereas the market basis is the current value, so market value minus any selling costs. This is important because the way we calculate profitability and the way we calculate solvency based on these two things would be different. If we're calculating profitability while we're increasing market values, we unfairly inflate some of those calculations of profitability. Generally, you're encouraged to keep a set of records that includes both cost and market values for your assets. So this is a balance sheet, and this particular balance sheet lists the assets and liabilities in three categories: current, intermediate, and fixed, or long-term. Current assets are assets that would be available or normally used in 1 year. So those are cash or near cash type of assets, supplies on hand, inventories, crop inventories. Intermediate assets would be breeding animals, machinery, livestock, or machinery and breeding livestock. These particular assets have a lifetime of 1 to 10 years. And then long-term assets would be usually just land and buildings, and these assets have a life of longer than 10 years. And then the liabilities are organized in relationship with the assets, so that the liabilities, the short-term ones, are due in 1 year, the intermediates are due in 1 to 10 years, and the long-term is due over 10 years. An alternative way of ordering your balance sheet is just to include the current and non-current asset categories. So current would be one year, and then non-current is everything over 1 year. This is widely done in the business world, but since farm assets fit these categories so well, with intermediate reflecting breeding animals and machinery equipment, that commonly agriculture is stuck with this particular form. Either one's acceptable. This one gives us a little more information. That's what a balance sheet looks like. What's a balance sheet tell us? Well, there's a couple of ratios and measures. One deals with liquidity, in other words, the ability of a business to meet the cash obligations as they come due without disrupting the current normal functioning of the business. The current ratio is a good measure of this, and it's simply the current assets divided by the current liabilities. In our previous example, that came to 1.3. If you're standard current ratio, if you're between 1 and 1.5, you're in pretty good shape. If you get less than 1, that means the current assets are less than the current liabilities listed on the balance sheet, and something's going to have to change. You're going to have to make some adjustments, or you have some cash flow problems. A low current ratio also shows that you have a high sensitivity to changes in price. Changes in price of assets can make you susceptible to cash flow problems. Then the next couple of measures up from the balance sheet, in other words, meanings we can get from the balance sheet, measure solvency, which simply put is if you cashed out the whole business, all the assets, would there be enough to cover the liabilities of the business? The debt to asset ratio measures the total liabilities to total assets. And the way I like to think of this is for every dollar of assets, it measures how many cents of liabilities there have. So if your debt to asset ratio is 0.7 or 70%, then for every dollar of assets, there's 70 cents of debt against those assets. If you have a 1, that means the debt's exactly equal to assets. If you're in the 30 to 70% range, that's a fairly stable. If you get much over 70%, then your farm business is getting pretty leveraged, and essentially the lender owns a higher percentage of the assets. Debt to equity ratio, it measures the total liabilities to the total owner equity, and another way of thinking about that is for every dollar of equity, it measures how many cents or dollars of debt. And if that's greater than 1, then it says you have a majority of the asset financing coming from lenders. 1 says the lenders in the equity is equally provided. So let's move on. I know I'm on a tight time schedule here for the amount we're going to cover, but I just want to introduce you to each one of these statements and highlight the most important things that we see here. This is the income statement, and it measures the income from the farm, the cash expenses from the farm, and then I noticed that not very many of you had made accrual adjusted income statements. It's really important to make an accrually adjusted income statement, because that way you're able to see what does the farm actually produce in your production year. So it takes into account changes in inventories, changes in accounts receivable, supplies, and things like that. And those are done in the income and expense adjustments. And you can get an income statement online, or you can see it in your textbook. And these income and expense adjustments are done through schedules, separate schedules, which adjust your different accounts. And this gives you a farm income, the net farm income from operations, it actually shows farm income produced in that year from the operations of your farm or ranch. It's much more correct number to base decisions on because it shows what you actually did that year without effects of carryovers and other things. And then it adds in sales of farm assets, capital gains and losses from those assets to get net farm income.